Hey Bowtie Nation, Joseph Hogue here with one of my favorite investing ideas, ETF investing. Investing in exchange-traded funds has been a hot topic over the last year, with investors pouring over $900 billion in ETFs last year, almost double what they invested in the year prior, which was also a record. And it wasn't in just those old index funds. More than 445 new exchange-traded funds launched last year to take ETF valuations to over $7 trillion in assets. In this video, I'll show you the top 10 ETFs investors are buying, what the funds hold in them, and how they fit in your portfolio. We'll look at the pros and cons of ETF investing, and then I'll reveal my favorite stress-free strategy for investing in exchange-traded funds. You know, we can't get started here on the channel though without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get to that list of best ETFs to buy, so we won't be going over the basics of ETF investing in this video. For that, I'll link to a video in the description below on how to pick an ETF for your portfolio, as well as the best monthly dividend ETFs and the Vanguard ETFs for your money. I'll be using the stockcard.io platform to research ETFs and see what each fund holds. Click through the link in the description and use the promo code BOWTIENATION, all one word in lowercase, for a special discount beyond the free trial. The Vanguard Total Stock Market ETF, ticker VTI, with over $43 billion in inflows last year. This one stock has it all. 4,000 stocks, including small cap and micro cap stocks, more than those large cap stocks just held in the SPY. We're going to scroll here to the price chart. It's up 25% in the last year and over 102% over the past 5 years. Now here on StockCard, you can scroll down on any fund and see what are the top stocks held. And here you're going to see a lot of the stocks held in the fund. It's going to be Apple, Microsoft, Amazon, a lot of those largest cap stocks in the index or in the market, but it also has those small cap and micro cap stocks, 4,000 stocks, really everything traded in the market. The next three most popular ETFs all covered the S&P 500, that large cap part of the market, the 500 largest companies based in the United States. The Vanguard S&P 500, ticker VOO, came in a close behind for second place at $42.2 billion in inflows. The Spider S&P 500 Trust, ticker SPY, had $33 billion in inflows, and the iShares Core S&P 500, ticker IVV, was really close as well, $26.1 billion. So you had more than $101 billion in just these three S&P 500 funds, more than 10% of all ETF investing last year. And we can scroll down to this price chart. We see the VOO did 26% return last year and 106% over the last 5 years. And if you scroll down to the top holdings here, the top 25 holdings, obviously you're going to see the largest companies in the S&P 500, the largest companies in the United States. These again were Apple, Microsoft, Amazon, Tesla, all those large cap American-based companies. We've still got 6 of the most popular ETFs to highlight, but why are investors suddenly rushing into ETF investing? Why is that trend to index investing gaining speed? First is that it's just such a great way to invest. Since Jack Bogle popularized his Vanguard funds, investors have loved that one stop for investing. And I think over the last few years, as so many new investors got started, they put a lot of their money into index funds while they were learning how to invest in those individual stocks. Now also though, when stocks get so expensive and uncertainty rises like it has over the past year, investors just don't know what to buy. So then getting a little bit of everything in an exchange-traded fund just makes sense. Why risk picking stocks if you really don't have to? Next here we have a bond fund, the Vanguard Total Bond Market, ticker BND, with $18 billion in inflows last year. Now if we scroll down to this price chart, negative 4.6% last year. Bonds sold off on higher interest rates, and it was only a 3.6% return over the past 5 years. Bonds and this bond fund are not going to make you rich, but it will protect you if stocks crash. If we scroll down to these to the top 25 holdings, we see a lot of United States Treasury bonds, and this is the entire bond market. So it's going to hold a lot of treasuries, it's going to hold a lot of mortgage bonds, it's going to hold a lot of corporate investments. Next here we have a tech fund, the Invesco QQQ Trust, ticker QQQ, with $15.9 billion in inflows in 2021. Now this one actually underperformed the S&P 500 last year with just a 23% return, but over the past 5 years, 215% return over the past 5 years. So an amazing return on those tech stocks, even though they slowed down last year. Now, this one owns 102 shares and actually tracks the NASDAQ 100, so the largest 100 tech companies based out of the United States. You scroll down here and you're going to see very similar to that S&P 500 fund because those just happen to be the largest 100 companies in either the NASDAQ or the S&P 500. So you're going to see a lot of these same companies, the Apple, Microsoft, Amazon, Meta platforms, which is the old Facebook. For more of the top ETFs to buy, but I want to highlight the pros and cons of ETF investing, and later I'll reveal my favorite strategy for both ETFs and individual stocks. Pros of ETF investing are that it's that stress-free way to make your money work for you. You don't have to worry about any individual stock crashing and burning your portfolio because it's just one of hundreds or even thousands of stocks you own. You're going to get that smoother market returns or the returns to a specific area of the market and fewer of the ups and downs you see in stocks. It's also a faster, easier way to invest. You don't need to spend hours finding the perfect stock to buy. You might spend an hour or two finding the best ETF with that lowest cost, but these are long-term investments that you'll hold for decades. Now, the downside to ETF investing is that investing broadly across the entire market or an index means you do give up that chance for higher returns. Investing in the total market fund, you're going to get the return on the total market, no more and no less. Now, there's also the cost of ETF investing, the expense ratio taken out of your investments regularly to pay for management. Now, that cost isn't much in the popular Vanguard or Fidelity funds, but it can get expensive in some of those niche ETFs. And finally, are some of these theme ETFs, like those around the growth stocks or special types of funds, might not really provide the same level of diversification that you might think. Now, if a fund is only investing in 50 stocks within a very narrow theme, you're still going to see a lot of the ups and downs around those stocks. Next here, the Vanguard Value ETF, ticker VTV. It was also really popular with $14.8 billion in inflows, and this is actually one of the top holdings of Warren Buffett's Berkshire Hathaway portfolio, 3% of his Berkshire portfolio. And we can see it did 25% return last year, beating out tech stocks and right around the return on the S&P 500. But then over the last 5 years, only a 58% return. So value has not beaten growth over the last 5 years, but is doing better over the last year and could be coming back in 2022. Here, if we scroll down to the top 25 holdings though, we're going to see Berkshire Hathaway, JP Morgan Chase, United Health Group, Johnson & Johnson, a lot of those traditional value names. You're not going to find a lot of tech stocks in here. You're going to find a lot more of the bank stocks, the financials, consumer staples, and these next two most popular funds tracked international markets. The iShares Core MSCI EAFE, ticker IEFA. And if you don't believe that's a mouthful to say, it took me 3 times to say that, folks. With $13.8 billion for that international diversification, followed closely by the Vanguard FTSE Developed Markets ETF. That's ticker VEA with $13.6 billion in inflows last year. Now, both of these funds track that market cap in developed markets, ex-US. So they hold stocks in a lot of these very large companies in developed international markets, hold a lot of the same shares together. So we're only going to look at the IEFA here. It had a 6.5% return last year, lagging the S&P 500 quite a bit. Over the past 5 years, only a 36% return. So international stocks have lagged the US over the past 5 years, but they're now even more in that value territory. This one holds over 3,000 stocks, so extremely diversified across that international spectrum. And if we look here, we see some of the biggest stocks outside of the US: Nestle, ASML Holdings, Roche Holdings, Toyota, and Novartis. A lot of the stocks that you might not be able to get exposure to in the US markets. And this last fund, before I show you the whole list, this Vanguard Short-Term Bond Fund, ticker BSV, had $13.6 billion in inflows last year, and I'm really glad this one made the list because it's probably the only bond fund I would even consider buying right now. Bonds are going to get hit as interest rates rise, so a lot of bond funds, especially the longer-term ones like the BLV, are getting hit hard and having massive losses. Now, this BSV, the short-term bond fund, since the bonds are shorter maturity, it's not going to get hit quite as bad as those interest rates increase. It's lost 2.7% over the past year and is up 1.3% over the past 5, but it's going to protect your money in case the stocks do crash, and it's not going to lose as much as interest rates go higher. And if you scroll down to the top 25 holdings, you're going to see the same thing, all these United States Treasury bonds that we saw in that total bond market. But the important difference here is that these bonds are all shorter maturity. They're short duration bonds. That's going to give it that protection against rising interest rates. And here you see a complete list of those top 20 ETFs along with the returns and theme for each. And note how closely the returns were on this S&P 500 funds, basically the same since they follow the same index. Bond funds have been the clear losers though over the last 5 years, with interest rates already hitting bottom and likely to head higher. So these won't make you as much money, but they are still going to protect you from that crash in stocks. Of course, the fast-growing tech stocks in the NASDAQ and the QQQ ETF, they were the runaway winners of the last 5 years, but the value stocks in the broader S&P 500 did just as well last year. Now, I want to share my favorite strategy for ETF investing, one I use in my own portfolio for a perfect mix of these exchange-traded funds and individual stocks. The strategy is called the core satellite because you have a core of investments that make up maybe 60 or 75% of your portfolio. These are those exchange-traded funds, the ETFs. For example, you might have 15% of your money in the Vanguard Real Estate Fund, ticker VNQ, which holds shares of companies in that real estate sector. Maybe you hold another 10% of your money in the Vanguard Long-Term Bond ETF, ticker BLV, which invests in hundreds of bonds and pays a 3.3% dividend. Now finally here, maybe you hold another 50% of your portfolio in a few funds for stocks, like one here, the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL, a fund of the best dividend stocks in the market. So here, by investing most of your money, that core 60 or 75% in just 3 to 5 funds, you're going to get instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds of stocks. You've got bonds in the bond fund and cash flow from that real estate ETF. Then, with that satellite portion of your portfolio, the remaining 25% or so of your money, you invest in individual companies that you really think could produce those higher returns. And this investing strategy works on so many levels. First, you get that broad investment through the funds. You get investments in all the asset classes and the themes. These are diversified and less risky because they're spread across hundreds of stocks, so you really don't have to worry about this part of your money. It's going to churn out the market return every single year. But now this strategy also gives you the opportunity to make that higher return on your small group of individual stocks. Because you're limited to how many stocks you buy, you're only focusing on the very best companies. You're not spending hours analyzing stocks every week because you've got your favorites and you don't need to chase every hot stock you hear about. Click on the video to the right to see exactly how to pick an ETF and the 3 exchange-traded funds every investor should own. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.